Randy Pierson here, Vice President of Life and Annuities for Gordon Marketing. And today with me, I've got Tim Luby, our RVP in the annuity space. And today we're going to be talking about something that if it's not of concern, it should be of concern if you're doing annuities, if you're selling annuities. And that is the Department of Labor rules and how they apply to you. If you're curious, stay tuned. All right, Tim, seems like about every 10 or 15 emails that I get in my inbox are from somebody wanting to help explain the Department of Labor rulings and how they're applying to annuity agents. What is it exactly, and what are some of the things that agents should know about that DOL rule that apply to them?
Well, in short, what is it? And this is a carryover of, some stuff that's been going on in the industry for quite some time. We fought it off a few years ago, and it's kind of come back now. And really, it's rooted correctly in that it's just trying to make sure that what's done with annuities for customers is in their best interest and that it's appropriate for them. So that's really where this is coming from.
All right, yeah. So best interest of the client is the primary concern. So who does this really affect? I mean, who are the people that are most affected by these new rules?
Right. Well, interestingly, and that's why you're getting so many emails on it, it really affects all qualified money primarily is what it affects. So whether you're securities licensed or just insurance licensed, doesn't matter what you're doing. If you're giving advice about qualified money, IRAs, 401ks, or anything like that, you come under this rules purview.
Okay, so agents or advisors who are helping clients do something with their qualified funds, right?
Yes.
All right. So who's fostering these new rules upon us in this industry, right? I mean, where is this regulation coming from?
Yeah. Well, it's kind of interesting. It's come from the securities industry itself. A lot of things that happen with the securities and financial industry seems to be things that we've sort of in some ways brought upon ourselves. This has been out there for a while, and it's been in an attempt to try to reduce conflicts of interest and make sure that people are not making a decision about their comp over the best decision for what their client will fit for their client.
Okay.
So that's some of where this is coming from. There's probably some politics behind it too, to some degree. I've been in the annuities business for a long time, so I feel like this is something that's been done to us. Yet at the same time, it's not a major change now because of all the noise that's been going on for so long about this. As an industry, we've responded, and we're doing a really good job of making sure that what our agents and our industry does is in the client's best interest.
Yeah, I would agree. It's interesting. It seems to me I've read some statistics over the years that clearly indicate that if you want to measure consumer complaints against financial advisors, a rather larger number of complaints tend to come from the security side of the business, from the fixed product annuity, FIA space, agent advisors. It's a huge margin. It's a pretty significant margin, right? I mean, fewer complaints come in our arena than in, say, the securities side of the business. But so what is an agent? What is an advisor? What does a producer need to know?
Yeah. So the big thing, I guess, is are they acting as a fiduciary? And there's really like there's 5 things that will help them decide that. Are they giving advice?
Okay.
Are they doing it on a regular basis? That's 2. There's 5 things. Is it the advice that they're giving? Is it agreed upon? Do they understand that is what they're doing? Is giving advice? And then is it the primary basis, that advice, for the customer making a decision? Okay. And then the last thing is it individualized? You can't get broad advice that works for everybody. It has to be for that individual, their qualified money, that individual's qualified money.
All right, and so I think some misunderstanding that some agents have out there is that the advice has to be about where the funds are coming from, say, for example, if they're held within securities, and if they're making advice or providing solutions that relate to indexing or index accounts, that's really the only areas that this pertains to, but it's not, right?
No,
it's much broader than that.
It is much broader. And while it affects certainly the non-securities licensed people, it'll affect the securities licensed folks as well. They may be a little bit ahead from a compliance standpoint because of the other rules that they have to live by, but just the same, they're acting as a fiduciary and they're bound by this.
Okay, so So here's the big question for agents out there. If they're not thinking about this question, they need to be, and that is, how do they stay compliant and keep their butts out of hot water?
That's good. Well, the first thing is to understand, it's their responsibility to understand what the rule requires. So
Okay.
they need to know.
Ignorance is not an excuse.
Yes,
right?
not at all. The second thing is they're largely on their own. The insurance carriers are not doing much to help with this. They don't have additional forms that are required as part of their app pack. They're leaving it up to the advisor. And I think the thinking there is that were they to take on a requirement that they get forms in it, they're taking on liability then, and they will be accepting sort of responsibility to it that they don't want to do. So none of the carriers, for the most part, are requiring anything different from an application packet. But there are ways to comply with the rules so that you are still in compliance. There are what they call PTEs, or prohibited transaction exemptions, that you can get. And there's a very specific one, PTE 8424, that agents can use. Basically, they have to get that form signed by their client, and it discloses commissions, and it will keep them, if they just get that form signed, carrier doesn't need to see it, but if they get that form signed, they're kind of covered.
Yeah, so just so they understand, to bring it really down to nuts and bolts, right, that complying with the DOL means documenting that the advisor disclosed everything that they were supposed to disclose, right? And we can assist with that, right? I mean,
Yes.
we've got some generic documentation forms.
Absolutely.
We've got tools that an agent can use to make sure, as I said earlier, their butt stays out of hot water, right?
That's right, exactly.
And so if an agent wanted to get their hands on those forms and perhaps get some additional advice and coaching on this subject matter, what do they need to do?
Contact me, Tim Luby at Gordon Marketing, or anybody on the annuity team at Gordon Marketing, and we'll help you with it. We'll discuss it. We'll give you the guidelines. We'll give you the sample generic forms that you need to use. And if things change, you can count on us to keep you informed.
There you go. That's all there is to it. I mean, that's really part of our role in assisting agents in selling insurance, life insurance or annuities, and helping you do it the right way, right? And meet your clients' needs and keep your butt out of hot water. So listen, with that, we're going to call this episode of Selling Life and Annuities to an end. I do want to briefly call your attention to our podcast. If you've not listened to our podcast, the links are below in the description of this video. Make sure you click that link so you can check it out. The podcast is great because, there are probably about 30 minutes or so, but we're able to dive a little deeper into subjects like this and give you a little bit more meat versus just the sizzle, right? So, but I need to call this video to an end. Make sure, by the way, you click subscribe at the bottom and the notification bell, so every time we come out with new content, you'll hear about it. But on behalf of Tim Luby and myself, happy selling.